Personal finance practice problem using Excel. Bank reconciliation. Prepare to get financially fit by practicing personal finance. Here we are in our Excel worksheet. If you have access to the Excel worksheet, would like to follow along, note that we're down here in the practice tab as opposed to the example tab. The example tab in essence being an answer key. Information's on the left-hand side. We're going to populate that into the blue area on the right-hand side, looking at a bank reconciliation scenario. Remembering that when you're thinking about a bank reconciliation, what you're doing is having your transactions that you have entered as you've made the transactions, comparing that then to the bank and to what the bank says about the transactions that you have made, and that reconciliation between the two, typically the reconciliation factors being the noting of the outstanding checks and deposits and checks which have not yet cleared the bank, but which you know you wrote. Those ending to be, in essence, the reconciliation items, gives you some assurance about your banking and helps you know whether or not you have these checks that have cleared or not. So normally, classically, you would do this in a checkbook register. So when you're writing checks, you would actually log this in. You might do it in, say, Excel. So to enter all your data as you're actually recording the data. You might do it with software using like a QuickBooks or OneNote or Wave accounting or something like that. You'll have a similar process with any of them. Remember that usually the outflows, meaning the checks, are often more difficult to kind of pick up from a personal standpoint, because the inflows, the deposits, often come from well-known sources such as our work. We got the deposits going in, we know where they're coming from. Hopefully they're greater than the checks, but obviously the outflows, we have more things happening or more actual transactions, and it becomes a little bit more difficult when we think of the fact that we're not always using our checkbook. So when we have the electronic transactions, that can make it easier and more difficult in some ways, because the electronic transaction we might not be recording into our checkbook in the same fashion as we do with when we were handwriting checks all the time. But the general idea still applies. We would like to be recording every transaction on our side so we can then compare it to the bank. Then what we would do is typically compare it monthly, at the end of the month generally, comparing what is on the bank side of things compared to what is on the books side of things. And if it's on the bank statement and it's not on our books, that means it's cleared the bank somehow. And that means probably means if it's not on our books, we need to add it to our books. We probably missed it unless there's an error, which we can assess at that point as well, which is a more rare thing that's going to happen. Or we could say that if it's on our books and it's not on the bank statement, then normally that represents checks or some other form of payment that we have written that we know about that hasn't cleared. And that's valuable information to us because it'll help us to know what our true balance is, because we know we wrote those checks already. And it'll help us to know if those checks cleared, so that we can verify if someone else calls us and say we didn't get paid or something like that. We could check and say, well, did you deposit the check? Did it clear the bank? Because we know we wrote it, because we said on our books that we wrote the check. We know we sent it out. And then the question is, well, did it clear or not? Okay, so normally what we would typically, classical example of the bank reconciliation we'd have two categories: the bank statement information and then our books on the left-hand side. So we got the bank balance and then the book balance. Let's call this bank balance to give it balance, and book balance. So we're going to imagine we got our bank statement here, and we're going to say the bank says that we have $800 in the bank. And then we say on our books, however, as of the same date, we're saying that the checkbook balance only has this much in we're going to say equals the $692 as of the same point. So we have a difference there, which we're going to reconcile, which is the bank reconciliation. So why does the bank say I have more money than I think I have? And normally we would think, well, that's probably because there's outstanding checks at the least, possibly outstanding deposits, and we might have things that the bank recorded that we haven't recorded on our side that we're going to have to add, such as fees or things like that we don't know about until we get the bank statement, possibly. So then let's add increases over here. We're going to say increase. So you're going to have increases and decreases on the book and bank side, and we have to decide where these differences apply. So we have checkbook balance. We have the outstanding checks. Now, if you're saying that we have outstanding checks, let's go ahead and highlight these as we go. I'll make them green as we go. We'll check them off with green. That means we did it. We've done that one already. So outstanding checks, that means that those are something that are on our books. If I looked at my list of registers, I have a list of outstanding checks that when I tied them into the bank balance, they're not on the bank statement. Meaning they haven't cleared at that point in time. They're outstanding. So what we would assume then is that they're still going in through the mail. They haven't yet gotten to the other person, and the other person has to deposit it, and then their bank has to talk to our bank before it actually clears. So we expect this timing difference to be the case. So our books, we assume, are correct. We don't need to adjust our number there because we know we wrote those checks. We're going to adjust the bank balance, say the bank is wrong, although they're not wrong like they made a mistake. They're wrong in that they don't have the information yet because of a timing difference. They're not aware of these checks yet. And so we're going to say this is going to be equal to the outstanding checks. Now note, in practice, you'd want to list out all the checks too so that you'd have a breakout. We're going to summarize this 187 could be multiple different checks, but obviously you want to have a list of what those checks are too so that you can see if they cleared. And oftentimes you can, if you're doing the bank reconciliation as of the end of the month, you can look till the point after the month possibly and see when those checks have cleared to give some verification that they have cleared, because there's two questions with those checks. One, they went out, so that's good. We have to make sure that our balance is correct and we're not overspending based on this balance being too high due to outstanding checks we know we've already written. And two, we want to make sure that these checks actually get cashed at some point so that we verify that we have paid whoever we're trying to pay, so we don't have a problem with them. And we could check that by seeing if the checks clear in the following month at some point. So I'm going to say this is going to be an increase of the outstanding checks. I'm sorry, that's actually going to be a decrease. Let's skip a couple cells down here and go down. We're going to go down to line 6. I'm going to bring this down to line 6. This is going to be a decrease. And the reason it's a decrease is because this is $800 on the bank balance. They don't know about the checks that left our checking account. So we're going to have to, and the checks are going to be a decrease to our balance. Therefore, our balance is overstated. We're going to have to make it go down with the outstanding checks. So we're going to say that's going to be the 187. And let's go ahead and make that green. We'll greenify it. And then we've got the direct deposits. Now, what we're saying with the direct deposits is that those are deposits which we may not have picked up on our side, because possibly those are deposits maybe that's not our W-2 that we pick up or something, whatever our normal income is. We got a direct deposit and it hit the bank account without us having recording it on our side. So we didn't see it until we saw the bank statement, in other words. And that means it's on the bank statement and it's not on our books. So what would really happen in practice is we'd fix our books. We would add it to our books. Now we're going to represent that with a lump sum total here that we'll just add on our book side, because we'll add that deposit into our books. Now, if you're doing your actual bookkeeping, it depends what kind of bookkeeping method you're using to do that in practice. If you're doing software or something like that, you'd have to add the transaction into the software, and you'd have to assign it to an account, typically an income account, if it was an increase that we don't have on our books. So we're going to say increases. We'll call it colon, and this is going to be the direct deposit. So we'll say direct deposit on the increase 94, and let's greenify that one. We'll make that green. And then we've got the fees, so the accounting fees. So the account fees, so this is going to be fees that we're imagining from the bank. The bank charged us for some kind of fees, and that's something that we didn't know about until we saw the bank statement. So we didn't record it on our side yet. We haven't recorded it on our side, so it's on the bank statement but not on our books. So typically when that happens, we have to fix the bank statement, and that's going to be a decrease on our side. So I'm going to say decrease colon. So we're going to have to decrease our balance by these fees that we didn't know about. This, once again, would be something that we would actually have to fix in our books if you were doing like accounting software. You call it fees and call it service charges or bank fees or something like that as the expense account and actually record it into the expense accounts. Here, we're just going to log it on the book side just to have the reconciliation between these two items. Okay, so let's make that a greenify. We're going to greenify that one. And then we've got the ATM withdrawals. Now, the withdrawals you should be recording. It'd be great if we recorded the withdrawals when we actually took the money out. And when we took the money out, we might even want to as well say why we took the money out so that we can assign it to something. Because obviously the problem with cash is, well, you can think of it as good or bad, but it's hard to track, you know. So if I want to know where I spent the money and I'm taking money out of the ATM, then I have to actually log down what I spent the money on, as opposed to any other kind of transaction where I can kind of figure it out by who I paid because there's an audit trail either through the bank or the credit card statement. So if I don't do that, if I just take money out and I don't record it, like oftentimes we'll do because we don't have our checkbook in front of us when we're at the ATM oftentimes. So we're not going to record that into our register, and we might just see it clear the bank, and then we got to verify. Notice when you do that, then you have less verification. If that's your method, in other words, meaning I take money out whenever I take money out, you know, and then I look at my banking account and I see what the withdrawals happen, and then I kind of look back and say, does that sound right? Did I take money out during that day? Probably, whatever. And then you move. That's what most people do. But notice you have a little less verification that was actually you taking the money out, right? If someone somehow got access to the ATM and took money out of your account, the way you could verify that is if you had the habit of actually recording when you took the money out on your side, and then when it cleared the bank, you could double check it that it cleared the bank properly, and when the two things didn't coincide, then you could see there's a problem. Again, a lot of people don't do that, right? They just kind of take money out whenever they take money out, and then you'll see it clear the bank, and you'll look back on it and try to review it and say, that sounds like I took money out. You know, things about right. I think I took money out like last Wednesday or something like that. And then you'll kind of figure it out. So notice the electronic transfers, there's pros and cons to that electronic transfer process. The money coming out should be fairly automatic. You should see it come out quite quickly. But if you don't record it on your side, you're not really doing the double verification. So we're going to imagine we see it on the bank statement, not on our books. We didn't record it. And so we're going to have to record it now when we took the money out. Now, from an accounting standpoint, if it was a withdrawal and you're trying to track where you spent the money, then you have a problem there because you don't know what account to hit with it. You could just call it withdrawals or something like that, or miscellaneous expense, personal expenditures. It's, you know, the cash, the none of your business account, because that's why I took the cash out in the first place, or, you know, so it's not category or whatever. So we're going to say that's going to be the $100. And that's going to be a decrease to our checking account. And I'm going to make that green. Let's go ahead and make that green up top. And then we got the deposits in transit. Now, the deposit in transit is something that we recorded on our books. We saw it on our register when we're comparing our register to the bank, but it's not on the bank register at this point in time. And that usually it takes less time for a deposit to take place, meaning if I went to the bank and made a deposit, or if I scanned a check or something like that, then it would have to be pretty close to the end of the month for it not to have cleared the bank. It might take up to like 3 days still possibly to clear the bank. And so you'd have that timing difference with the deposits in a similar way as we have with the checks, meaning I know I made a deposit. And so it should have, I'm going to delete that outstanding checks there because it's a decrease. So the deposit, I know I made a deposit, so I should include it in my books. My books is right because it includes that deposit. It hasn't yet cleared the bank. So that means that we have to add it to the bank side, not because the bank is wrong. It's not an error on the bank side. They just don't have the information yet because it's outstanding. It's a timing difference. Now, note, again, that one we can check fairly soon. If it doesn't clear in like 3 days, we can check our banking transactions. And if it still hasn't cleared, then we have a problem. We want to make sure that we go back and check that deposit, which is another reason, once again, that you want to be recording the deposits on your side as much as possible, which is something that with the electronic transfers that people are doing kind of less and less, right? The deposit The deposit comes in and you record the deposit electronically when it clears the bank, instead of recording it first on your side and then verifying that it cleared the bank, and which you kind of lose the level of double check if you're not recording it on your side first before it clears the bank. Then you're losing a bit of the double check with regards to the bank reconciliation process, because it should be two sets of books that you're kind of double checking, the bank side and then your side. So then we're going to make that. And then we got the interest earned. So interest, if you earn any interest on the checking account, then that's going to be something that will be on the bank statement, but not on our books. Meaning I didn't record the interest we earned on the checking account on our side because I didn't know how much interest we earned till we got the bank statement when they told us how much interest we earned. So that means we're going to have to, that means the bank balance is right. We didn't record it on the books side, and we're going to have to include it on the book side, and it would be an increase because we got some interest. So we're going to have to record that. In practice, if we're reporting this in like QuickBooks or something like that, then we'd have to assign an account, which would be a revenue account of interest income of some kind. Okay, so I think we've got that. So now let's call this is going to be the total increase. I'm just going to say this equals the total increase here. I'm going to do some indentations. We'll select these two, go to the Home tab, Alignment, Indent. Let's indent this again. Alignment, Indent. Let's put an underline here, Font Group, and Underline. And then I'm going to indent this one, Home tab, Alignment, Indent. And we'll call this the total decreases. Total decreases. Let's indent that 2 times. Alignment, indent, indent. I'm going to make the decreases negative so that we can sum up. So I'm going to double click on this and put a negative in front of it instead of a plus, flipping the sign. And then I'm going to say this equals that 187 negative amount. Let's put an underline here, even though there's only one number, Font Group and Underline. And then I'm going to put the total down here. This will be the adjusted bank balance. So our ending adjusted bank balance, then I'm going to sum up the outer column. They started at the 800. We're going to increase it by the deposits in transit. The 63, we're going to decrease it by the outstanding checks, 187. Doing that with the trusty sum equals the SUM sum, shift 9, up arrow, holding down shift, up, 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 and enter. So we're at the 676. Now let's see if that happens on this side over here. So we got the total increases. I'm going to sum up these two increases, the direct deposit and the interest that we didn't have on our books before, but now are including. Sum of these two. Let's put an underline here. Underline, a line underneath the stuff, underlining it. And let's indent these 3. I'm going to go to the alignment and indent, make it look a little nicer. Alignment, indent, fancifying it. It's now fancy, meaning that's why I say fancify. It's been fancified because it's more fancy. So then total decreases are going to be over here. Let's do the same thing and make the decreases a negative. So I'm going to make these a negative. I'm going to put a negative sign in front of it, making them negative, and I'll put a negative sign, and then we'll equals the sum of the 2 negative numbers for the account fees and the ATM. Let's put an underline here, doing some formatting stuff. Font group underline. Let's do some indentation. Selecting these 3, we're going to go alignment, indentation. Let's do it again. Alignment, indentation. And that's going to be our adjusted book balance. Trusty sum function, summing up the beginning balance, plus we're going to make the adjustments. And these are actually adjustments that we would actually have to make to the book. So now that I have the bank reconciliation done, you would then have to go and kind of add these to your books if you're doing like a bookkeeping system, assigning accounts to these items, meaning the checking account is obviously going to be affected. The other side having to go to most likely income accounts for the deposits, most likely expense accounts for the decreases. And so let's do the trusty SUM, shift 9, up arrow, holding down shift, up, 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 and enter. So there we have it. Let's put an underline here, font group underline. put an underline there, font group, and underline. So let's put a double underline on these. I'm going to hold down Shift or Control and select both of these, font group, and let's do the double D underline. So there we have it. So now we've got the same number, of course, for the adjusted bank balance and the book balance. We're going to make the adjustment to our books so that that is actually the book balance. And once you have done that, then the bank balance is really kind of the bank reconciliation, meaning we're going to adjust our books for these differences that we need to be recording because they were on the bank statement but not on our books. We agree with them. The bank didn't make an error, so we're going to fix our books. And then this side represents the reconciliation after that is done, which represents the outstanding deposits and outstanding checks that most likely will clear in the following period in the following month.